Howdy, Jacob here. Today we're looking at Entegris in the semiconductor and semiconductor equipment industry. 15.6 billion market cap, 19.4 billion enterprise value. They supply micro contamination control products, specialty chemicals, and advanced materials handling solutions globally. Founded in 1966 out of Massachusetts. Revenue growth is extraordinarily impressive, with no revenue growth declines over the last 10 years, averaging well into the double digits. It's very impressive. Gross margin increasing, operating margin increasing. Gross margin most recently 42.5%, with operating margin 16.4%. They have paid a dividend since 2017. Looks like it's a very inconsequential amount in relation to their earnings per share. Or not very, but it is not a heavy amount of their earnings per share, so they can likely very much afford it. Return on invested capital average is okay. There was a spurt of time between 2018 and 2021 where it looked pretty consistently double digit, but outside of that, nothing to really brag about. Balance sheet has about just under $500 million in cash and cash equivalents. No short-term debt, but $4.6 billion long-term debt. So huge funding of acquisition going on in 2022, which we can see through debt issuance. 4.5 billion acquisition, issued 4.9 billion in debt. Their use of funds is very heavy on the acquisition side, with their dividend, as I said, being a very minor amount of free cash flow, but it is still 60 million cash allocation going towards dividends. Nothing to share purchases. They did buy some shares between 2016 and 2022, but it was a very minor amount, and they haven't done anything the last 3 years. That's enough to make me ready to do some analysis on it. So I think with some acquisitions, again, we saw here there's a big acquisition followed by big growth of revenue. I like to assume 100% capital allocation. And so that means that I'm not assuming a company is going to go into debt to issue acquisitions. I'm going to use 100% of free cash flow allocation to be able to do so. And so I think revenue growth could very easily be about 8%. Maybe that's being conservative, but again, I'm saying about 50% or so of capital allocation goes towards acquisitions. And in doing so, their margins have gone down with this acquisition. I don't like that. I loved when the company was just being more efficient, and then looks like bought a company that lower margins. I don't really love that. Hit the top line well, but not so much the bottom. So I'm thinking that it's going to probably be closer to the more recent margins. And with that, I'll even be generous, 8 and 10%, which since their most recent large acquisition of about $4.5 billion, almost 30% of about 30% of their market cap, really hit those margins. So 8 and 10, I feel fine with. 1% for them is about 156 million. Okay, stock-based compensation is not really much, so we'll assume 0.5% there. PE, price to free cash flow, I'm thinking 8% growth, a lot of it to acquisition, not necessarily being more efficient with their acquisitions. So maybe just because of growth, I'll give them an advantage, but nothing too crazy. And then the dividend, I'll give them growth with revenue, saying that payout stays at 20%, or the very marginal amount that it is currently, with majority going to acquisitions. And in doing so, we're saying it needs to fall 79% before you get the return look for here. So again, not a huge surprise. I think if you really understand this business and you think they can get back to that 20 to 25% operating margin pretty easily, then that could be something that could definitely be an avenue to go down if you're absolutely confident about it. But for me, given what I'm seeing and given the most recent history with that acquisition, I don't know if I feel comfortable making that assumption. So for me right now, I'm definitely holding off until it gets to a more attractive price. Hope you enjoyed the video and have a great rest of your day.